Let me talk to you about how credit card processing works. I mean, it's really important that whether you are a retail business owner, you're a restaurant owner, or you are just interested in knowing a lot more about credit card processing in general. Here is a process I want you to pay attention to. So, within a few seconds, it usually takes for a credit card transaction to be approved or declined. Several, and I really mean several small steps are taken via an internet or a phone line connection. You have a conduit of several connections and two main stages to make up credit card processing. Then you have authorization, and then you have settlement. It's really important to remember those two things. So authorization and settlement. And so I first want to talk to you about authorization so you have a clear idea what I'm talking about. So card details and purchase amounts must be first verified and authorized by the issuing bank. And this happens in the few seconds it takes for a cardholder's credit card to be approved or denied. And the message often shows up on the card machine after a cardholder swipes or enters a card. So step number one, the cardholder swipes, taps, or inserts their card into a merchant's card machine to make a purchase or enter a card number if purchasing online, right? Step number two, the merchant's credit card machine sends the card information and transaction details to the acquiring bank or merchant bank or credit union via the internet or a phone line. Step number three, the acquiring bank receives the information and sends it along to the appropriate card network like Visa, MasterCard, Discover, or American Express. Step number four, the card network routes the information to the cardholder's issuing bank or credit union. Step number five, the issuing bank receives the information and checks the card details such as the card number and card verification value, the CVV code, to make sure the transaction is not fraudulent. The bank also ensures the cardholder is in good standing and has enough remaining credit to cover the purchase or has sufficient funds to cover the transactions if using a debit card, for instance. Step number six, the issuer sends a response back via the card network to the acquiring bank or credit union. And step number seven, and this step is really important, the response is received at the merchant's credit card machine or terminal. If all the credentials in step 5 check out, the transaction will be approved. Otherwise, it will show a message like denied or on the machine. And the cardholder sees this information right away and finishes the transaction while the response code is stored on the merchant's machine for stage 2 of processing. And so this process that I just described to you may vary slightly depending on whether the transaction happens in store or online. And traditionally, merchants set up a merchant account with an acquiring bank and link the point of sale system to an account. And merchants can set up accounts with merchant service companies like Square. Doing so removes the need for merchants to set up a direct relationship with an acquiring bank, but adds another middle person to the equation. I want to talk to you about settlement. So you have for instance, you have authorization, and then you have a settlement. And then the second stage of credit card processing, settlements, happens among the merchant, acquiring bank, card network, and issuing bank. So this is important. Those are four elements. Those are four sort of counterparties that are really involved here: merchant, acquiring bank, card network, and issuing bank. And this settlement process involves much back and forth from party to party and includes the addition of processing fees charged to the merchant. And that's kind of cool because it adds an extra layer of trust and credibility to the process. And each credit card authorization is stored in a merchant's point of sale system. Typically what happens here is that at the end of the business day, a merchant sends a batch of authorizations to the acquiring bank, and the acquiring bank will then confirm each authorization and send the batch via the card network to the appropriate issuing bank. And the acquiring bank will also deposit the funds owed to the merchant into the merchant's account minus any processing fees. Of course, those processing fees can be as much as 2% or 3%, depending on how everything is set up. Okay, so that's for the acquiring bank. Now let's talk about the issuing bank. The issuing bank pays the acquiring bank via the card network. Then the card network debits the issuing bank for each transaction amount and credits the acquiring bank essentially, when you think about it, essentially acting as a conduit between the two, right? And when a cardholder checks their spending activity via their online account, he or she may see a recent change go from pending to posted. And this usually takes 1 to 3 business days as the merchant settles sales with the other parties, because the merchant still needs to settle sales with the other parties. I mean, this happens within 1 or 2 days, and in some cases it might happen instantaneously. But yeah, there is a process that goes beyond. There's a sub process that goes beyond there, and the cardholder later pays the issuing bank what they owe for every purchase plus any fees or interest accrued, as per the card agreement. So that's really an important element to think about. Let me talk to you about finance here. So let's talk about credit card processing fees and cost specifically. And the thing is that basically all credit card processing companies base their pricing structures on 4 primary fees. This include interchange fees, you have assessment fees, processor markup fees, and monthly account or statement fees. And knowing what goes into credit card processing fees can help you understand what your options and spot the best payment processing service for your business in the first place. It also depends on what kind of business you have in the first place, though. So let me first talk to you about the interchange fees, so we have a clear idea. So interchange fees are set by Visa, MasterCard, Discover, and other brands, including American Express. And these are the unavoidable base level cost of processing credit cards, often called wholesale or base fees. Interchange fees generally range from 1% to 2% of the transaction amount. And payment processing companies collect interchange fees during the transaction process. They then transfer these funds to issuing banks as payment for the credit service. And interchange rates vary greatly and depend on the merchant's industry, the transaction type, and the brand and type of the card issued or the card used. And so let me give you a few examples of factors that impact interchange rates merchants pay to process credit cards. So you have, for instance, you have transaction type, debits versus credit card brand, card type. So when we talk about transaction type, card not present transactions such as online sales have higher interchange rates than in-store sales where cards are physically swept. Debit cards have lower interchange rates than credit cards because they are considered a lower credit risk. The card brand also plays an important role. So Discover and American Express have higher interchange rates than Visa and MasterCard. And the card type, so rewards, corporate, and governmental purchasing cards have higher interchange rates than non-rewards cards, since those programs cost the issuing banks more to administer. And you also have assessment fees. So really, the assessment fees, actually often called per transaction fees, are also set by the card brands. Those are flat per transaction fees attached to interchange fees and typically range from 1 to 5 cents based on the type of card and transaction. So as with interchange fees, assessment fees are collected by card processing companies during the transaction process. However, those fees are paid to the card associations such as Visa, MasterCard, Discover, and American Express, not to the issuing bank. I want to talk to you about the processor markup fees. So besides interchange fees and assessment fees, you also have processor markup fees and also monthly fees. So markup fees are what credit card companies charge for their processing services, because they need to monetize those processing services too, right? And markup fees actually vary based on the card company's processing fee structure, such as a straightforward markup percentage called interchange plus, complex tiered rates, or simple flat rate fees. And those fees are kind of complicated, but the thing is that they are adapted to every sector, every niche, every card type, and so on and so forth. And each fee structure has benefits and drawbacks, which really depends upon the specific issuer. Bottom line is that markup costs vary greatly from processor to processor. So it's really essential to shop around for the best deal. So if you're a merchant, if you're looking for a merchant account, you got to really shop around. And if you have any question, let us know in the comment section, and one of our team members will get back to you. And you also have monthly fees. So in addition to markup fees, many credit card processing companies charge monthly fees for specific services such as statements, online gateways, PCI compliance, and card terminals and other processing hardware. Some roll all of those services under a monthly account or subscription fee. So a few such as Square, Stripe, and PayPal charge no monthly fees for credit card processing services. However, those providers typically have higher flat rate processing fees that can cost more compared to processors that combine monthly fees with lower rates. So you have to really see what really works for you, and the best deal for you will have to depend upon your geography, will depend upon your card types, and the transactional volume you really process every single month through the gateways or through the specific credit card processor. And you also have to ask yourself, what is your vision when signing up for a merchant account with this processor? Let me give you other costs to consider here. Now, some credit card companies have add-on and conditional fees that can really affect your overall processing cost. And it's one of those things where it's a decision you have to make before actually reaching out to a specific credit card processor. What kind of a goal do you have in mind, right? So to avoid surprises on your monthly statements, you always check the fine print for add-on fees when comparing credit card processing companies. And so let me quickly talk to you about the other costs to consider here. So you have chargeback fees. Unfortunately, chargebacks are an inevitable part of accepting credit cards, and the cost of processing a chargeback varies greatly among processing services. You have a batch processing fees. So some tiered and traditional merchant services providers charge per batch fees, and that could be a little problematic. It could be high or low depending upon your transactional volume. You also have setup or termination fees. So card processing services with negotiated or tiered rate plans often require contracts with setup costs and hefty early termination fees. I mean, we actually have an entire video on the subject of switching actually a merchant account, and there are actually termination fees. There are fees inherent in the process. So you have to see what works for you and what doesn't work for you. This is a decision you have to make. You have to make really, really clearly with a clear operational vision insight. You also have monthly minimum fees. So some negotiated and tiered rate plan providers charge a monthly fee if contracted transaction volume minimums are not met, right? Because they want you to really stabilize their revenue also. So if they don't get that revenue, they're charging you. You also have a same-day funding fees. And most card processing services actually deposit funds within 1 or 2 business days with no added fees, but charge a fee for instant or same-day access to processed funds. So if you're in an industry where you actually want to have access to your funds right away, you might have to pay for it. I mean, it is a cost you should be willing to accept as part of business. Okay, if you want to really increase your cash inflows versus cash outflows, then you have to really accept those same-day funding fees. So bottom line here is that when we talk about other costs to consider, think about chargeback fees, batch processing fees, setup or termination fees, monthly minimum fees, and same-day funding fees. Let me talk to you about the pricing structures. So when we talk about pricing structures, you need to really understand that the most common payment processing models for small businesses include flat rate fees, interchange plus fees, and tiered rates. So understanding the pros and cons of each is really key to finding the best service and processing rates for your particular needs. I want to start with the flat rate pricing. So flat rate pricing is the simplest fee structure and typically charges one low rate for all credit card transactions, regardless of the type of card used. And many flat rate processing services also provide free sales tools such as P.O.S software, free card readers, and integrated online gateways for e-commerce sales. And with flat rate pricing, business pay they pay like one low rate based on the type of sale, with fees typically ranging from 2.5% plus 10 cents to 3.5% plus 30 cents per transaction. And again, the delta here depends on the specific niche and merchant account that you have. And with flat rate structures, in-person sales where the card is present have lower fees than online sales. But fees don't vary based on card brands or a rewards program. Plus, you don't have add-on fees for PCI compliance or monthly statements. And flat rate pricing can be a good option for businesses with low average transaction amounts, especially when considering free perks such as P.O.S system, online gateways, and card readers. However, higher volume sellers can save on credit card processing costs with Interchange Plus or tiered pricing. So this is really important to think about. I want to talk to you now about Interchange Plus pricing. So Interchange Plus pricing is growing in popularity, mainly thanks to the small business friendly plans offered by Helsum, Payment Depot, and Stacks. And Interchange Plus payment providers add a minimal fee to the base interchange rates set by the card associations. Some, such as Helsum, mark up the interchange rate with a small percentage and per transaction fee but have no monthly fees. And markup fees can range from 0.10% plus 5 cents to 0.50% plus 25 cents per transaction based on the sale type. And others, such as Payment Depot and Stacks, don't mark up their interchange rate. Instead, they pay a monthly subscription fee with a minimum per transaction fee ranging from anywhere from 5 cents to 15 cents per charge. So that's kind of cool. So when comparing providers, you always want to remember that markup rates are in addition to the base interchange rates, which vary based on transaction specific factors. Even so, Interchange Plus models are very transparent and often the most economical choice for businesses processing more than $10,000 in monthly card transactions. Now I want to talk to you about tiered pricing. So when you think about tiered pricing, I want you to think about a standard pricing structure used by traditional merchant service account providers and business banking services. And to set tiered plan rates, providers first audit your business model and transaction history. So it takes more work to get this type of plan in place, and but it is really worth it. Most tiered plans also require lengthy contracts and charge early termination fees if you want to change plans or providers. And so tiered plans break card processing rates into three groups, which are called qualified, mid-qualified, and non-qualified tiers. And each tier's rates are based on the merchant's overall processing volume. So that's basically your transactional value, the industry and typical transaction types, such as online or in-person sales. And each sales tier is determined based on, let's say, on the transaction type, credit card used, and whether or not the cardholder's billing address is verified. So the thing here is that it's all about what? It's all about risk mitigation. I mean, some transactions, such as card present, are less risky than online sales, for instance. Okay, and tiered rates can be tricky to. One thing we have seen is that in most cases, qualified transactions have the lowest rates, while non-qualified transactions have the highest rates. And tiered rates can be tricky to understand, and the monthly statements can be very detailed. And it's one of those things where if you are by yourself, if you are, say you are a one-person business or a 10-person business, you don't have the team to really go granular on those statements. If you have a large team, yes, you can go with tiered rates. For most small businesses, flat rate or interchange plus plans are more economical and easier to manage based on our research. However, higher volume businesses in certain industries, such as wholesalers and multi-store retail outlets, can save with a tiered card processing model. Let me give you the strategy here. How do you reduce your credit card processing cost? Now, credit card processing fees are basically unavoidable, but there are several ways to minimize their impact on your bottom line, and you should try to minimize their impact on your bottom line starting today. So first of all, you got to know your effective rate. That's kind of important. Then you want to negotiate card processing rates. You want to review your statements. You want to reduce fraudulent charges, and you want to consider zero fee processors. Let's really dig a little deeper here. When we talk about knowing your effective rate, it really means that you want to see if you're spending too much on card processing. It's a simple formula that divides total card processing fees by total card sales for a given period of time. It's essential to include monthly fees, statement fees, and add-on costs that your provider charges in your total processing cost. If your processing service charges $39 per month, your total processing cost is $137.25. In other words, you are looking at you have to add the monthly processing fees, and if your monthly processing fees are $98.25 for 3,275 in total card sales, your effective rate is 3%. So $98.25 divided by $3,275. So this is we're going to put the math on the screen, okay? After plugging in the total monthly cost into the formula, the effective rate is a whopping 4.2%. So that's an important element. In this case, a flat rate processing service with no monthly fees, such as Square, which charges 2.6% plus 10 cents to a 3.5% plus 15 cents per transaction, might be the better deal. You also want to negotiate, as I told you before, negotiate card processing rates. Don't be afraid to audit and negotiate your rates with your processor every year or so, especially if you have a tiered plan. If your processing volume is higher than before, or if you have expanded into more than in-person sales channels, you are ready to negotiate lower rates. You want to review every line on your monthly statements and ask your processing service for answers or clarification if something is unclear. Interchange plus and tiered statements can be complex, as I said a little earlier. So take the time to review the processing charges and added fees, and use the effective rate formula to know the average rate you pay each month and for each sale type or processing tier. That way you know exactly how much you're paying. Thank you so much for your attention. I really appreciate it. In today's conversation, I spoke to you about how does credit card processing work. I gave you the process, the finance part of things, the pricing structures, the strategy, and the recap. Thank you so much. God bless you. I'll see you next time. Until then, remember, stay marvelous.